Hi, it's Chris from the Trader Guide taking a look at the weekly charts for the upcoming June 4th sessions. And one of the main reasons I'm doing this is because every once in a while the market lines up in multiple different places to give you an idea as to what it may choose to do. And what I'm seeing is found on several different charts. In fact, I've got at least five weekly charts that I'll show you. This is the euro dollar, this is the British pound dollar, this is dollar yen, Aussie yen, and pound yen. And they're all forming hammers at support levels. The most important thing to know about this is that every single one of these charts is pointing to a risk-on move. I could give you 100 reasons as to why we should not have risk on, but perhaps we're just oversold in risk appetite. I think that's a very viable argument. So when we look at the euro dollar, we've pulled back to basically the 50% Fibonacci retracement level 115, which of course is psychologically important. It's structurally important, and we formed a hammer. So if we can break above the top of the hammer, the idea is that we should rally. The question is how far do we go? Well, using Fibonacci, we should go all the way to the top. Now, how does that happen? Well, perhaps people stop worrying about Italy so much. Maybe somebody steps in and fixes some of the issues. I mean, there's a lot of possibilities out there. You can see just how structurally important this level is. So, at the very least, you would expect some type of bounce. We've broken out, we've tested it, we've gone higher. Now we've tested it again. We've oversold, obviously. So perhaps there's a bounce to be had. There's also an uptrend line there, yet another reason to expect support, which shows just how dramatic a breakdown would be here. So really at this point in time, I would suspect that there's probably more proclivity to the upside. The British pound pulls back to the 38.2% Fibonacci retracement level. This is a little bit different situation in the fact that we have the structural support, obviously, and resistance from the past. We have the hammer on the weekly chart. We have the 38.2, but we also have the very real possibility of higher interest rates in the UK sometime over the next year or two. So this would have more structural support anyways. Beyond that, if money truly is fleeing the European Union, it's probably going to London, so that would make sense even in that scenario. So obviously very strong. Over here, dollar yen, I think 110 is a serious barrier. If we can break above it, that negates a 2-week shooting star. Breaks through several shooting stars here, shows extreme strength, probably going to about 115 by the time it's all said and done. We are trying to validate an uptrend, and remember, this is a very risk-on type of market. Now, the Australian dollar's been one of the most interesting markets that I've followed over the last several weeks because we just keep forming hammers here at 75. One of the best trades that I have found have been buying a double or a triple hammer. We have 4 out of the last 5 weekly candle forming hammers. So that to me screams that at the very least there is major support here, and I think it's likely that we go back up to 80 given enough time, that we're just simply going to try to establish some type of consolidation. One of the reasons I say that, this is not necessarily a trade I'm willing to take, but we have major consolidation in the New Zealand dollar, and most of you will know that the Kiwi and the Aussie tend to move in the same direction. This goes back 2 years between 68, and there's a zone here between 74 and 75. We are closer to the bottom. A break above the top of this candle very well could get the markets buying again, so it makes sense that the Aussie would do the same thing. And then finally, the granddaddy of them all when it comes to risk appetite, the British pound Japanese yen pair. The question is, you can make an argument here for a trend line break right about there, but the question then you have to ask is, are we trying to form a new trend line? So there is that kind of uncertainty in this pair, but we do have a hammer, and we have it at the 145 level, an area that has been important in the past. I think we're probably going to get a bounce regardless. This is going to be very sensitive to things like North Korea, which it's been announced late in the week that Trump and Un are going to meet. That's back on, so that could help. This is going to be risk appetite with the markets overall, stock markets and the like. And then, of course, the British pound looks as if it's ready to recover a bit too. So that could also throw more fuel on the fire. And in fact, 150 I think is important, but it might just simply end up being the middle of consolidation. A little early to tell that right now, but it does look as if we're going to, at the very least, bounce. So I think the next week, maybe 2 weeks, could be positive for risk appetite. Can't really tell you why, other than a couple of random things here and there. Italy's calming down. It's not fixed though. That's the catch. And the summit, or perhaps it's just exhaustion on the part of the sellers. But certainly, every once in a while, the markets line up like this. So it's very important to be aware of everything that happens. The NASDAQ 100, an index I follow for some clients, broke out above 7,000 on Friday. There was a good jobs report. So I think we're going to see the buyers of risk assets come back in the short term.